Hey travelers, how are you? This is Nitzan Mosri. Happy New Year and welcome to 2019. I wish everybody had a safe entrance into the year. Nothing too major happening to anybody. It's been a fantastic 2018. Personally, myself, closed on a bunch of assets all around the Atlanta area. Got some things rolling. Got the radio show. It's been an incredible year. Let me ask you this out there in all over the world. What are your goals for 2019? Have you set them up already? Last week and the week before, we were talking about setting goals, looking back within the past year and seeing what worked, what didn't work, and then starting to tweak everything that didn't work and throwing gasoline on everything that did work. So have you done that already? Have you taken the time to sit back and do it? And if you haven't, this is the time to do it. You don't want to wait too much longer for the year to start kicking in, because before you know it, we're going to be sitting at the same place here, but next year, right? 2018 for me went by so quickly. It was as if I closed one eye, I opened up the other, and here we are at the end of the year. And it just showed me how much more I have to do in 2019. I had a great time in 2018. We did what we did. We learned, we progressed, we moved forward. 2019, we got to take that and take it to the next level. And, a lot of my show is based on how to teach people how to create passive residual income through commercial real estate investing, right? Warren Buffett says it best, right? If you want to become wealthy, you have to learn how to make money while you sleep. You have to teach your money how to go out and make money. And today's guest is someone who has done that, but has done that in such an incredible level. It is phenomenal. I met Jean-Marc, I would say almost about 9 years ago. We were traveling in the same circles of the different real estate programs and the different real estate conferences all around the country. We bumped into each other several times. We started talking. He and my business partner, Laura, they both speak that French stuff, and they were talking, yapping, and it was wonderful. And from there, Jean-Marc and myself and Laura, we went out to partner up on several deals. The one thing that Jean-Marc has really been successful at is in creating groups of people, investors, where they go out and they show them what they do, and then he's taken that to where he's been able to raise incredible amounts of money. It's funny because Jean-Marc's background comes from engineering, right? He did a short stint in the engineering world. And then back in 1982, he got into real estate because he wanted to buy a home. He couldn't qualify for the loan, which is, at that time was 19% interest. I remember my dad bought a home in the 80s, and he was paying 18% interest on the mortgage, and people were saying that was cheap. So he was looking to offset his loan payments with some rental income, and whatnot. And he discovered that on 5+ units, lenders looked at the rental income from the building and not his own income. Cha-ching, right? The bigger you go, the less they look at you, the more they look at the asset itself. And then you know what? He went down and he started buying. He went in and he bought a vacant 6-plex in San Francisco, rehabbed it, rented it out, and then refinanced it to pull out 4 years worth of engineering salary. So from one property, he was able to pull out 4 years of salary because of the equity that he built, right? You don't need to go anywhere else, right? Suddenly you have that kind of success. You're like, okay, how can I do that again? Can I do that again and again and again and again? And guess what? 36 years later, he continues to structure and manage commercial real estate projects for the benefit of his investors and his entire team. He works with investors, he project sponsors, management team, tenants, and suppliers. They all go out there and they all benefit from what Jean-Marc has learned and what he goes out and he teaches. So Jean-Marc, welcome to the show. How are you?
I'm great, Nizan. Thanks for having me. It's really fun to be here, and Happy New Year to everyone.
Yeah, man. Happy New Year. So what did you do during the New Year?
So every year we do this big French, like 7 to 8 course dinner. And as usual, I had fun in the kitchen. And
Beautiful.
Actually, both my kids and new son-in-law came home. My daughter got married last year. So
Congratulations.
we had 4 chefs in the kitchen. It was a lot easier than many years.
That's
Very
great.
often at 1 in the morning, I'm still toiling in there trying to get dessert on the table.
That's great. That's great. But that's what it's about, right? It's about being with family, spending time, having the time and the ability to do that as well, right? Not many people have, the ability, have the time availability, have the financial availability to take the time out and to have family and to do all that kind of stuff. So it's pretty incredible. And so tell us. So you started out way back when, 1982. I was just 12 years old at that time. I was becoming a man. I was preparing for my bar mitzvah at that time, and you were looking to buy a home. So you started out as an engineer, right? You liked the numbers and you liked all that kind of stuff, right?
Yeah, totally. So really, it was about looking at real estate. It was a neighbor. I got into conversations with my neighbor in the apartment building, and he started talking about real estate. And I should buy a house. And then it's kind of one thing led to the other, and I ended up buying the sixplex. And of course, I didn't have the down payment when I was looking at multi-units, so I was looking at something distressed.
Mm-hmm.
So I bought a property that was in foreclosure and condemned, and quit my job and rehabbed it. And 9 months later, did the refi that you mentioned. And kind of the rest is history. I never went back to my cube.
That's great. That's great.
Another sixplex, another six, another 15. We rehabbed a 42 for someone else. So got into contracting. And then in 87 on a 15 unit, did an incredible rehab. Then San Francisco being San Francisco, we went to the rent board to get our capital improvement pass-throughs to increase the rents, because we moved the tenants out, moved the tenants back in at our cost.
Mm-hmm.
Some of those people were still paying $150 rent, and then we were trying to increase the rent by $100. So from 150 to 250. Now market rent was already 650 at the time or more.
Wow.
Still couldn't go past the 250, and the rent board said, well, you can't possibly increase the rent by $100 at one time. That's just too much. And whatever the law allows you, which is the $100 or whatever the number was, we're going to phase that in over 10 years. So
wow.
Instead of amortizing the cost of the rehabs at 10% over 10 years, because that was the number at the time, at the end of 10 years, the cost was tripled because of accrued interest. And the city attorney was telling them, no, you can't do that to him. And their reaction was, well, if he doesn't like it, he can take us to court. So at 26 years old, I took the San Francisco rent board to court, and I won. But it was a Pyrrhic victory. Won the battle, lost the war, because in 87 the economy turned, and I went from having a $300,000 profit on that building to dumping it for a $30,000 loss.
Oh wow!
But I just had to get out. It was negative cash flow. I'd rolled the construction loan 4 times. I'd paid the attorneys ridiculous amounts of money. And it was like, okay, what next? Mm-hmm. And what do you do with lots of experience and no money in the bank? And I went to a seminar on buying mortgages. And back then, people were, seller carry mortgages were a common thing with interest rates still high. People couldn't qualify. So we would buy out, maybe someone sold their home, carried back a second. Now they wanted to pay for their kids' college or whatever. We would buy that out at a discount. Mm-hmm. And so I learned how to really, slice and dice these mortgages. You can take, half of it and peel it off. You can take a tail end. You can sell a 30-year mortgage and keep, sell the first 10 years and keep the last 20 years. With time value of money, you can usually, let's say it's a $100,000 mortgage, you can sell the $100,000 mortgage, for a slight discount. Let's say I buy it for 80, I sell it for 90. I sell the first 10 years for 90. So I have 20 years of cash flow starting 10 years from now, plus I have a profit up front.
Wow.
And this is all the stuff the banks are doing, through all this time. Mm-hmm. But it really is slicing and dicing cash flow. So over the years, I've learned to do that with other things. So I was doing a loan as a loan broker for someone buying an office building that was short on cash. I said, well, let's take a look at the cell tower lease on the roof. So you're getting $1,200 a month. I can probably get you $120,000 for it, as sort of the reverse of a mortgage.
Right.
And we ended up not doing quite that. The leasing company wanted to take the entire roof because it was the tallest building out in 20 miles. And they leased an easement on the entire roof and paid the guy $320,000. out of nothing, out of thin air.
Hmm.
So
Wow.
I've cashed out lottery winnings. I've cashed out mortgage or insurance settlements. It's amazing what you can do. Trading cash flow for lump sums of cash and backwards.
Sure.
So when I look at these large apartment buildings that we do now, it really is all about cash flow. And I'm sort of jumping around a little bit, but I ran my loan company for 15, 20 years. We funded over $1.5 billion in loans.
Hmm.
So I've seen a lot of real estate. And after the 2008 crash, I was kind of scratching my head, and what stuck in there was this one refinance I had done. It was a client who had a $200,000 loan on a $1.2 million condo in San Francisco, and it was a rental. I was cash flowing a whopping $3,000 a year on $1 million of equity.
Wow.
And it's like, why are you keeping this? Well, it's positive cash flow. Well, not that much. And so I talked to her a little bit. She ended up selling and investing $1 million with a private money mortgage company.
Hmm.
Started making 11% on her money. So she went from $3,000 to $110,000 a year.
That's great.
And when everything else crashed around us in 2007, I had 28 loan agents in our brokerage. I had a house factory. We were doing prefab housing,
Hmm.
and we had just gotten entitlements to build 570 homes in southern Utah, and the bottom fell out. I'm going, okay, what now?
Mm.
So that was fun times.
That was fun times. So let's talk about that. So, you seeing what's behind the scenes, so to speak, right? A lot of investors don't understand the financial mortgage business the way you do, right? Like you said, you've done over $1.5 billion of funded real estate, right? Of funded money. So where do you see the economy right now? Is it, a lot of people are talking about, another recession coming, another dip, a correction here and there. What do you see happening? From your knowledge, from your perspective.
Actually, that's a complex question.
Mm-hmm. I like to ask complex, complicated questions. Absolutely.
Let me polish my crystal ball here a little bit. No, I think just we both know that economic cycles are a matter of when, not if.
Right.
And so we've been in an upcycle for the better part of 9 years.
Mm-hmm.
It's going to dip. There's no question. But it really depends on where, location. So, back in 2009, San Francisco was not crashing because it didn't really crash here, but definitely in tanking. Texas and other areas were crashing. North Dakota was going through the roof.
Mm-hmm.
And I funded a hotel loan there. This hotel had gone from $50 a night at 50% occupancy to $110 a night at 96% occupancy.
Oh, wow.
They were housing oil workers. The buyers were not fooled, and they were buying at a 20 cap. They were using old numbers and not boom time, so they're still okay.
Mm-hmm.
But it just gives you a sense of what was going on here was not going on there, and vice versa. Now Minot is kind of a dead town, and everything else is going off. So that's going to reverse at some point again. So, where are we in the economy? That's a great question. I think, some strong metros are going to continue going strong. There are certain metros that we target. The Bay Area doesn't cash flow, but I as an investment place, I wouldn't invest here. I'm not investing here.
Mm-hmm.
Actually, that's not true. We closed yesterday on buying a piece of land to build a senior care facility.
What kind of facility?
Senior care, so assisted living,
Mm-hmm.
independent living, and just the beginnings of assisted living.
Mm-hmm.
We don't go into memory care or anything like that, but so we just bought the land yesterday. But that's really the first piece of property in California that I've bought since 1987.
Right. Yeah. It's a tough market. It's like you said. It's not a cash flow area to be in. It's like South Florida. You don't buy properties for cash flow here.
Right. And for appreciation, yes, but that's not our goal. So
right.
if you're an insurance company that has cash flow that wants to shelter taxes or whatever, and long-term, go for long-term appreciation, you can buy all you want here.
Mm-hmm.
Will go up. But when you look at other areas, there's been a strong upswing along in many states, and I think that's going to correct. I don't think there's going to be a sharp downturn. At least I'm hoping not.
Hmm.
I don't think we're seeing a bubble like we had, in 2007, 2008.
Right.
Um, that being said, I think the stronger markets are definitely going to do well and better than the weaker markets. And there may be a correction, correcting down 2, 3, 4, 5%. Some markets may go down a little more than that, and then right back up.
Right.
But that's my hit again.
Hmm.
Don't know if my crystal ball is cloudy or not.
All right. Well, you heard it here, travelers. You heard it first from Jean-Marc, right? Some markets will take a hit and some won't. That's basically the gist of it, right?
That's a little like my favorite saying. There's no such thing as a one-handed economist. On the one hand, it can go up. On the other hand, it can go down. So
exactly. There you go. There you go. So
I think, just to give you a little more hit on that. I mean, the markets that we're targeting, we're looking mostly west, just because I'm tired of flying to the East Coast.
mhm.
But we're looking at the Seattle markets, Salt Lake, Phoenix, still playing in Dallas, but not much. We haven't found anything that makes sense lately.
Right.
We bought last one we bought there was about, no, that's not true. I bought one this year.
You just don't know. You just don't know. Huh?
So we closed 3 deals this year that were not syndicated.
Oh, okay.
These were single investor deals, which is sort of a departure. And then the senior care facility was a syndicated one that we just closed.
Okay. So let's talk about that. Okay. Let's talk about syndications, right? So what was one of the, when you started going big, or when I met you about 9 years ago and whatnot, that obviously wasn't the first time you were buying multifamily, as you mentioned, you bought way before. But what was some of the challenges for you for scaling up, for going big, for blowing it up the way you've done? What were some of the challenges that you've come across, and how did you guys answer those challenges?
So after managing 6plexes for close to 30 years, jumping into 100 or 200 plex is a little bit different, obviously. Putting it together is way more complex and definitely a team sport. It's not something you do on your own. Even for masochists like me that work 24/7, you need a team. And I remember the first project I was involved with, I just raised some capital for someone else's project, and that was relatively easy. As a loan broker, I knew who my investors were.
Mm-hmm.
I've been financing condo hotels, so all those guys were investors, and I raised some money for that. So it was a 152 unit in the San Antonio area.
Mm-hmm.
Then we put together our own 172 units, and I tried to raise money from those same investors. And it's very different from, even people that I had done, 3, 4, 5, 6 mortgages for. There's complete trust. I knew everything about them up and down. I knew where their money was and how much they had and how they were investing. And they still didn't want to go into real estate and invest with me. It was a completely different animal. And as we're going through a month and a half in escrow, I go, oh crap, we're not going to make this raise. And that's when I think I reached out to you guys, and you guys came in, put that together.
Right.
And then I think the next one after that we worked on, you guys put it together, and you're going, oh crap, we're not going to finish the raise. And no.
That's right. That's the beauty of networking.
It's team sport, totally.
Absolutely.
So when you get into the big ones, just the volume. If any of you have looked at the loan documents on a commercial deal, the loan documents alone are somewhere between 300 and 500 pages. And a lot of it is boilerplates, and you can't really change anything, but you still have to be completely aware of what's in there.
Right.
And not all of it is boilerplate. I missed one recently. We've been quoted an exit fee of 1% that was waived if we refinanced through them. And somehow the paperwork got written up as an exit fee of 2%.
Oh.
And this particular lender ended up selling the loan to someone that we really didn't like and didn't refinance through them, and it cost us an extra $140,000 to replace a $14 million loan that we didn't expect to pay. And so that came from not catching one change in a 500-page document, or it's really 20 documents, total 500 pages.
Yeah, that's crazy.
But the appraisal might be 300 pages. The engineering report might be another 400 or 500. The environmental report, another couple hundred. It's just so much reading. And you have to have a team behind you that understands what they're looking at, that understands what what to look for, so you can go through that fairly quickly. And when you're putting it together, you're obviously vetting the market. You're finding the asset within that market, making sure that the asset is what you think it is. So doing your due diligence, hiring contractors, hiring inspectors, going through third-party reports. You're raising the capital. You're setting up the debt financing, the debt on it. You're finding the management company to make sure that once you close, you're ready to go, and you're not going to continue the negative cash flow or the anemic cash flow that you're buying, because that's pretty much what we target.
Right.
Stressed properties. So it really comes down to building the team and the body of knowledge within the team that you can actually take down more than one asset at a time.
Right. Right. So one of the challenges that I heard you talking about was raising capital, because you come into this knowing that you had a huge network of investors, but once you approach them with something, they kind of said, "Whoa!" So now and doing the syndications, as we know, going from friends and family and raising 50,000 here, 100,000 here, that's great when you're raising $1 million, $2, $3 million, right? But when you're going above that, right, you need to be able to have at your fingertips access to a ton of people, right, or a handful of very deep pockets. So how did you overcome that?
So that's the ongoing question, of course. I think everyone always faces ongoing capital questions, and no matter how much capital you have, you always want more. And we've been targeting. So we started out with individual investors in the Bay Area. We formed. It's a meetup group, Bay Area Multifamily, BAMF for short. That my son told me was an acronym for Badass MF. I'm not going to say that on air, but it's an easy thing to remember. So BAMF has grown from the original 0 to we have over 5,000 members now.
5,000 members.
Yep.
Wow.
And
how long did it take you to grow 5,000 members?
We actually have 14 different groups, all in the Bay Area, because the way Meetup is set up. But we feed everything into, it's two physical meetings a month and one webinar, and then plus other educational stuff. But from that, we've raised a little over 30 million in the past 2 years.
That's amazing.
So that sustained us through a number of projects. We took down several, 16 million, a 17 million, a 20 million, a $30 million project. Even we're right now in a $50 million construction project. We're building 330 units in Buffalo, New York, student housing. And that we did from small investors, raising 100,000 at a time. We also did this past year, went after a $30 million existing multifamily in the Seattle area that we ended up not being able to put together. Our major partner came to the table a little too late. That was actually a $12 million raise. We got to raise in 3 months. And we figured we'd get, about a third to, a quarter to a third of that from our investors and the rest from our family office. What we learned from that is that we didn't have our family office investor in place up front. And a number of them liked the project, wanted to get in, but wanted to change the terms of the agreement. And by then we already had raised $3 or $4 million from our investors. Okay, we need to change everything here.
Yeah.
And so we ended up backing out of the deal and losing all our due diligence money and whatever. But we got some partners. I have 5 or 6 family offices now that are ready to buy with us.
Oh, that's wonderful.
So, if they're willing to write a $5 or $10 million check, and we bring in another $2 to $5 million from our investors, take down a $30 to $50 million deal.
That's beautiful.
And then other things. It goes back to the creativity that I learned on financing the construction deal. We've raised $7 million so far. I think that may be close to all we need. We may need another couple million to do a $50 million deal, because we're looking at bond financing for the construction on that. Which is a much higher loan to value, loan to cost than we can get through any other and any other means really.
So let's talk about that for a second. You mentioned a couple of development projects. Why have you moved from the value add, already pre-existing assets to new construction? But, new construction is just it's a headache. It takes a long time. The investors don't see a payout for a while. So what are some of the advantages of doing a development project? And travelers, those of you out there that are listening, if you haven't done a deal yet, if you haven't even bought a house or anything, don't do a development deal on your first deal. Don't do a repositioning on your first deal. Make it simple for you. There are ways of doing real estate without going out and developing. You have to be incredibly savvy like Jean-Marc. You have to have a network of people that you can raise, a total of $30 million from to make something like that happen. So, that being said, what are some of the advantages of going out and building your own project?
So a lot of this started, 2.5 years ago. I started really questioning where the economy was headed, and thinking, it's going to correct again. It's going to correct. And becoming very, very cautious. And a lot of the multifamilies we were looking at didn't make sense economically. And we were still looking at value add, and we've been buying value add. But then we connected with some guys in Provo, Utah, that were builders, and ended up partnering with them on building. It was a mixed-use project in a suburb of Provo called Springville. So we ended up building, that was 41 units, 58 storage, and 4 offices. And that we actually closed on the purchase of that just this past April. So it took about 18 months to build, not quite, about 16 months to build. But it was really looking at the existing housing stock there. There wasn't much that was of interest. There was one in Salt Lake itself that looked very attractive, and we asked who else was bidding on it, and the church was bidding on it. So this is Salt Lake. I'm not going up against the church. Okay, what else do you have? So we ended up building with these guys. Our investor was a single investor that wrote the check. They qualified for the construction loan. We gave them essentially the down payment, and then we had a pre-agreed purchase price. So on that one, we had agreed to buy for 8, ended up being 8.12, I think, by the time we were done with all the change orders. We upgraded the counters to granite and stuff like that. But the appraisal came in at 9.4. So at closing, we already had $1 million plus of equity built up.
So I guess that would be one of the upsides to developing, right? If you can do it in such a cheap way where the appraised value comes in higher than what you've paid for it, that's a good thing.
Right. I mean, it's I almost did a loan for this was a decade ago. These guys were trying to build a hotel in Niagara Falls, New York. Why they're using a broker on the West Coast didn't make sense, but I started running the numbers and I started understanding the cost to construct was higher than the end value. So they kept looking for someone who was going to tell them something different, and I told them the same thing they had heard before. So I think they started building for cash. I don't know why they were built for cash when it didn't make sense. But most of the time, like this deal in Berkeley, we bought a piece of land. It's 6 medical office buildings, like old bungalows and whatever that have been converted to medical office. And we're replacing it with 135 units senior care facility. So this first stage really is just an entitlement phase. So you're taking a piece of land and going from something you can have, 6 little bungalows on to something you're allowed to build 135 units on. All of a sudden, that chunk of land is worth more.
Sure.
Just as once you build that, it's worth more than the sum of the parts. So part of the development, obviously, there's certainly increased risk. There's a much longer development cycle. There's no cash flow, all the negatives. But then you look at the positives. The student housing and senior housing are the 2 development sectors we've really looked at, other than this one multifamily, which was like timed perfectly in the middle of the boom. Those are products that in a downturn actually do just fine. That's somewhat recession proof.
Right.
People are still going to grow older, and people are still going to school, especially when they can't get a job.
Right.
So we went into development as a way to get slightly higher returns and just sort of offset. Every portfolio needs a balance. So some things have cash flow up front and not as much pop on the back end, and some have little cash flow or no cash flow up front and a much bigger pop.
Right. Right. Travels, I want you to pay attention to what Jean-Marc just said. It was something very, very important, that when you're building your portfolio, it needs to be balanced, right? You need to, because some, like as he said, some assets will pay out good cash flow, but the appreciation won't be there. Some won't pay out some good cash flow, but then when you go to sell it, you get a nice big chunk of change. So you need to have different types of assets in your portfolio to kind of balance it out and to keep the cash flow and the appreciation going at the same time. So that's a very unique strategy to have. So let's
Nitin, before we turn me in a different direction, there's a great example that I've used many times, but it really brings this home. So in 1985, I bought the sixplex that I live in San Francisco, and I paid $395,000 for it, which, I mean, that's the cost of a studio condo, maybe in the outskirts, far East Bay today. But and then I had friends' parents in New York City on the Upper West Side, which wasn't a great place to live at the time, but a duplex co-op on Central Park West for $401,000. So basically the same amount. So this was a long time ago.
Right.
Fast forward 30 years, I have been positive cash flow on my building, even with just the 5 units and living in the 6th from day one. And I've lived off this building. I've done cashed out refinance several times, invested that money. It's built my business. It's saved my butt several times. The co-op, that, for those that don't know co-ops, you really can't do much. You can't finance a co-op. You can't put it in a trust. You can't do estate planning with a co-op. It's so restrictive. Co-op really, you own shares in a corporation that owns the building, and then you have exclusive use of your particular space. But you can't assign those. You can't. There's so many restrictions. You can't do anything. But here's the thing. There are co-op fees that for maintenance on the building and paying the doorman and everything else. Over the years started low and then up, and they were like 14, 15 grand a month by the time they sold. But they sold a few years back for $26.5 million. Okay. From 400,000. My $400,000 value went up to 4 million-ish. So which is the better investment?
Sure.
They have paid every single month since they've owned it. I've received money every single month since they owned it, but they sold for like 5 or 10 times what I can sell mine for.
Right.
So again, for an insurance company, theirs is better. For me, mine is better because I would have lost theirs. In the downturn, I didn't have that 14 grand a month. I didn't have 5 grand a month.
Right.
So it's really important to look at what your goals are, what your investment strategy is, and choose the investments in relation to that.
Right. Yeah, absolutely. Absolutely. It's a good point. Speaking of goals, you just mentioned goals. What are some of your goals for 2019? Where do you want to take your company?
That is still in process, but the goal, excluding reality, we're looking to do anywhere from 3 to 5 deals, but trying to do deals with single investors or just a small number of investors that can write $5 or $10 million checks.
Right. So
ideally, like on the Seattle deal, where we had about 30 investors in a group that made up about $5 million, and then we had one company that was going to write us a $7 million check for the balance of the down payment. So even better would be one person writing us a $12 million check for the whole thing. The difference there obviously is you have one relationship to manage, and most of our time can get focused on managing assets and making sure we're doing our job. Right now we have half or more of this team split, calling 300, 400, 500 investors to get the 50 or 60 that come to the table, and then we're managing 50 or 60 relationships.
Right. How How oh, I just lost my train of thought. You were talking about the investors and the raising the capital and whatnot. So how long has it taken you to build these relationships with these one investors so that they can come and just stroke you a check? This is a long process that you go through, right?
On the one hand, it is a long process. On the other hand, it's not when you think about it.
Mm-hmm.
They obviously want to see a track record, and that's probably the biggest thing. If you don't have a good track record, they're going to cut you out.
Right.
And the investor giving you $100,000 is not going to have an entire team going through your books. And if you tell them what your track record is, they're going to believe you.
Mm-hmm.
The family office has an office set up to do their due diligence, and they're going to go through all your past project, and you can't spin it. You have to tell them the truth.
Mm-hmm.
And this is what the results are here, and this one was a success, and this one was a success, and this one didn't do as well, and really lay it all out. And then obviously they need to have some confidence that you're going to, once they write that check, you're going to do what you're supposed to be doing.
Mm-hmm. And you found these family offices through your meetup. Have they come to you, or you've gone to different conferences and walked around and networked with people?
No, I've gone to conferences and networked.
Mm-hmm.
And I think a lot of it has to do, beyond just the networking, it's really having a project that works. So the first one really was, another cohort that we both know, Scott and Chris, brought me a deal in Alexandria, Virginia. That was very sweet. It was 570 units, 110 million. We obviously couldn't take that down on our own, but with $50,000 checks at a time. So went out looking and partnered with a firm, and we ended up making an offer at 110.5 million.
Wow.
And someone came in at 111 all cash. I go, my wallet's not quite that fat.
Wow. You can't compete with that.
Clearly a REIT. So, those guys will buy with us. And that's sort of ongoing. They're actually the investment arm of a management firm that manages two of our assets.
Oh, okay.
So they already knew how we ran the assets. They knew, they were already managing a $20 million asset for us.
Mm-hmm. Mm-hmm.
So there was actually some connection there.
Okay, very good.
And then when we rolled out the Seattle deal, that was just a very sweet deal. Again, location. We were right next to Alaska Airlines. They were about to build an office building across the street, the first of 4 towers, actually. The FAA was moving 1,700 jobs into a new building a quarter mile south of us. So all this stuff is booming. It's like the path of progress.
Mm-hmm.
So
how do you find your markets that you get into? What do you look for when you go into a market?
Job growth, and job growth.
Mm-hmm. And where do you look for these statistics?
Sometimes I get lazy. I mean, I know how to do it, but I call real estate agents.
Mm-hmm.
I call people in my network like you. And it's just it's network. This is the son. We hold our meetup at the offices of the conference room for New York Life, or the training room for New York Life downtown in San Francisco. The son of one of the New York Life agents is an agent up in Seattle, and he just brought me an off-market deal last week. So we're slowly getting that in the door. Mm-hmm. And so again, just network. But we look at statistics, look at news, look at all of the big brokerages have market reports, and it's going to be top 10 this, worst 10 markets, worst 7 markets. Mm-hmm. And you have to look at is that for single family, is that for multifamily, is that for office, is that what's that for? And everyone has the same list, or everyone has different lists. The top 10 for Forbes might be a very different top 10 that Cushman & Wakefield puts out, for example.
Sure.
What stats are they really looking at? And then you can kind of dig in from there. Have access to CoStar and Reis and Axiometrics and all the data points. But we did Chancellor in Northwest Houston. It's sort of between the good part, where the ExxonMobil campus is going in with 10,000 new jobs, and 10,000 new jobs really means 40,000 new jobs by the time you get all the ancillary support people moving in to support that population.
Mm-hmm.
And then south of us is Greens Point, also known as Guns Point. And
we're right on that border, man.
Is our asset going north, or is our asset going south? We turned it north.
Mm-hmm. Mm-hmm. Absolutely.
So, it's really all about job growth, and sustainable, and what's driving that, and is that going to continue to drive?
Right, because there's you'd mentioned North Dakota or whatnot in the beginning of our conversation, and with all these man camps, right? People thought they were going to be permanent jobs, but they were temporary, right? People bought all this land, all these properties, and then when all the men that were filling these man camps left, because that was it, there was nothing left to do, everybody lost their shirt. So it's really important to find out what type of job growth is happening in that market. Right? Is it the permanent job growth, the jobs that are coming in? White collars are moving in, creating those jobs, building, filling in the office spaces, and then the ancillary will be created? Or is it just, coming in, taking care of a job, and then moving back out of that market? So it's really important to figure out what kind of jobs are being created. Right? And a good source for that also is the Economic Development Committee, the Chamber of Commerce. Yes, you can definitely talk to commercial brokers. They'll know exactly what's going, who's going where, and what's happening in that market. So, what advice would you have for people that are looking to get into multifamily investing right now? What would you say to someone who's getting started?
Okay, so I think you have to look at the three different ways of playing. So there is being completely passive and just investing your money with someone, in which case, in all cases, get yourself educated as best you can. Mm-hmm. And really find out who you're trusting, and the real estate is one thing, but the people you're investing with is another.
Right.
And when things go south, are they going to go running for the hills and sell? Or are they going to put up some of their own capital and tough it through and make it all work?
Mm-hmm.
So you have to vet your sponsor and as well as the real estate in the market they're going into, and see if they're credible. So that's on the passive end, and the downside of that obviously is you're giving up your money to someone else's control, and you really have no control other than collectively all the investors can get together and fire them and hire someone else to manage the assets. Mm-hmm. But there's really not a whole lot of control. Then you can do completely on your own, on a small scale or large scale if you have the pocketbook, but buy a 6-plex or a 50-plex and just manage that on your own.
It's funny. I was running some numbers on a 20-plex, and the 20-plex was throwing off better cash flow if you were doing it one or two people than a 150-unit complex that I was looking at in a different market.
Right.
Because when you're doing a bigger deal, when you're doing a $110 million deal, you've got a lot of other team players in there. You've got to cut up that pie, right? And then your piece is a sliver of a big piece.
Right. And then you also have to look at where is it? Right. I mean, my 6-plex in San Francisco might be worth $4 million, but we bought a 248 unit in Dallas not too many years ago for $5.4 million.
Exactly.
248 versus 6. I mean, it's a vastly different animal.
Mm-hmm. Mm-hmm.
It's almost the same price. So you have to look at the markets, look at the pricing,
right,
and the rents. It's not just by the door. And you bought things by the door for $20,000 a door, or for $500,000 a door.
That's right.
Markets, different animals.
So you were saying, so there's three ways. So there's the passive way, there's on your own.
There's on your own, and then there's jumping into the game yourself and learning how to syndicate your own deals.
Mm-hmm. That's right.
And syndication doesn't mean huge groups. If you have a single investor that is trusting your knowledge to do something passively, that is a syndication.
That's right.
And you need to go through all of the paperwork and everything to do that. Now, there are ways around that. You can give them enough power and duties and make sure that you involve them in the decisions to get around syndicating with one or two people on board. But many people make the mistake of just doing a joint venture partnership when it's really not. It's really a syndication and just structured wrong. So it's really, completely passive, just on your own, or jumping in with both feet. And one is you're staying in the job and you're just investing your money. The other is completely getting in on your own.
Right.
And build the team in all cases, learn as much as you can, and really figure out what your own goals are. I mean, it's really important to know. If you're working 80 hours a week, like a lot of these guys in Silicon Valley here, you don't want to be managing a property. I mean, I remember, I managed apartments all over the city. I owned 57 apartments in San Francisco at one point. And the calls at 2 or 3 in the morning, something's leaking through the ceiling, and I'm locked out. Or, and then I have my electrician calling me at 8 in the morning and go, "Where are you? I'm at the job site and you're not here." So we had an appointment. Yeah, we talked 3 hours ago. We talked at 5 this morning. It's like, we did. I know I have a phone by the bed. That was in my sleep.
You got to have fun with this, right? You got to have fun. You got to laugh at it. If you don't laugh, you're going to end up crying.
Yep. And then on the big ones, so the nice thing with the big ones is they're not completely passive, but they're passive.
Right.
I mean, we asset manage, but we literally have the on-site management team. So we have 1 or 2 people in the office, 2 or 3 people doing maintenance out in the field. And then they're managed by a management company, and they have attorneys and CPAs and the whole team behind them, and then we're just managing them, as opposed to dealing with tenants and toilets.
Right. So. Awesome. Well, Jean-Marc, man, we have a minute left. Why don't you share with the travelers out there, if anybody wants to reach out to you, how they can find you?
So our website, probably the best way to find information, is finat.com. F as in Frank, INATT, short for financial attunement. We're tuning up people's finances, making your money work for you. So finat.com. Direct phone number is 415-484-5626. Again, 415-484-5626. Happy to talk with anyone who's looking to get in at any level of the game. So
great. Well, Jean-Marc, thanks so much for being on the show. You've given us a lot of in-depth information, a lot of great nuggets. We appreciate you. I know you're very busy. I know you got a lot of things going on. So thank you so much for being on the show.
Thank you, Nizan. It was a pleasure.
Take care. And travelers, I'm going to leave you with my old Irish blessing that I leave you with every week. May the road rise up to meet you. May the wind always be at your back. May the sunshine warm upon your face and rains fall softly upon your fields. Until next week, this is your traveling investor, Nitsan Mosery. Be well and be safe.